It is the end of the year. Have you got everything done when it comes to your tax checklist? If not, you want to listen to this because we're going to walk you through all the key areas.
We hope you've been enjoying all the episodes from Secure Your Retirement. If you'd like to keep learning and receiving these episodes, hit the subscribe button and the bell so you receive alerts when they come out. We've helped thousands of listeners get on the path to securing their retirement. Now it's your turn. Let's dive in.
Welcome to Secure Your Retirement Podcast. It is amazing to sit here with you, Merce, and know that we are at the end of 2025.
It's crazy.
So we hopefully have put out a lot of good content, a lot of good reminders, and we said, hey, we're right here at the end of the year. What could we do to kind of say, hey, you're listening to this, maybe you're getting ready for the holiday, maybe you're getting ready to leave. You know what? Let's do a checklist. That last minute checklist that says don't make a mistake before the end of the year. And so that's what we want to do today. We're going to talk about some key areas that we need to make sure that we don't forget about. And we're going to run through these things. We're going to try to give you as much as we can. I would encourage you that if you're listening to this episode and you're kind of maybe you're walking or you're driving, we've got a blog on it as well. So it'll have all this information in there. But this is going to be that last minute. Don't forget, oh my goodness, this could make a big deal. So Mercer, I'm just going to turn it over to you. And if you can kind of take us through some of these key elements that we want to think through, why we need to think through them, how we need to go figure out, did we do it right or not?
Yeah, absolutely. And this list is not exhaustive. I'm sure we could come up with all kinds of things to make sure we want to check on in the financial and the personal life and all these different things. But some common ones that we come across here at the end of the year that we want, our team is always making sure that we've taken care of for our clients is there's a handful. So the first one is your RMDs. RMDs have a deadline of 12/31. So at the end of the year, your RMD or required minimum distribution needs to be satisfied. That's all I'm going to say on that one for right this moment. We're going to talk more about RMDs on the back half of this episode, but that's a big checklist item. There's penalties involved. You don't want to miss your required minimum distributions from all of the accounts that are required to take a distribution. Another big one is what we would call capital gains management or tax loss harvesting. So in non-IRA type accounts, like a brokerage account where you bought some stocks in and they've appreciated over time, and maybe you have some stocks that have done well, maybe you have some stocks that haven't done as well. It's a time at the end of the year where a lot of people will jump to, hey, I can do some optimization of this account by selling some of the quote unquote losers so that I can harvest a loss on my for my capital gains, and now I can keep maybe one of those winners in check that maybe is starting to get to be too big of a position in my portfolio. I can sell some of that because I have harvested a loss. I can offset some gains at basically a net zero type of tax situation. One of the issues with this type of brokerage account, is that if we don't monitor it and if we're not actively harvesting losses, we can get to a place where we've got very concentrated stock positions. Some key stocks that a lot of people have fallen into this situation are your stocks like Nvidia, Apple, Tesla, Microsoft, right? We see it all the time. And the common phrase is, I've got these golden handcuffs because they've done so well for me, but now I can't sell them no matter how I feel about the stock because I don't want to deal with the tax implications. One important thing that I think that is to talk about here is, Radon, a lot of people wait to the end of the year to do what we call tax loss harvesting. But in a nutshell, if you want to just kind of bring up a different strategy that I think is a little bit more proactive when it comes to harvesting losses and gains.
Yeah, one of the things that we have set up for our accounts that we are managing for our clients that's not IRA money is we actually are doing this on a very regular basis. It's the way Merce and I do it with our own accounts. It's the way we set it up for our families this way. Is that if I'm dealing with an account like that, what I want to do is on a very regular basis, no less than once a month, what we're going to do is we're going to go look at throughout the entire year and say, what are my losers and what are my gains? And I'm going to be offsetting that. So I'm doing what we would call tax loss harvesting all year long. Because if I wait till the end of the year, I'm going to get a little bit of benefit, but I can truly maximize that benefit if I do it throughout the year. So if we're sitting here at the end of 2025 and you're thinking, man, I didn't do any tax loss harvesting this year, I'm going to go take care of this right now. Let's think about, well, in 2026, let's do it all year long. We actually have a whole system in place that's going to make sure those checks and balances get done throughout the year. I will tell you, it's not something that you just can, just think you're going to go in and do and forget about it. It has to be a systematized approach, but it can mean a lot. Let me just give you an example. If you were just saying, "Hey, I want to invest my money and I want to make sure that I'm tracking either an index, or I just want a portfolio that's going to keep me at a pretty good risk tolerance." Could you imagine what if you're making another 1 to 2% extra because of the tax advantages of that, all net dollars to you? Now think about that over time. That's pretty massive. That compounding is unbelievably massive over a long period of time. So I'm going to tell you, we are seeing great benefits. We are seeing exactly those numbers that I'm just explaining to you, 1 to 2% a year. We're seeing clients right now that are getting many thousands of dollars a year in benefit on their accounts because of doing this. So it is huge. And I'm going to tell you, if you don't know what I'm talking about, it's one of those reasons why you might want to have a conversation with us.
Yeah, absolutely. Okay, another big checklist item is charitable giving. So if you're charitably inclined, we want to make sure that you are giving in the right way so you get the most tax benefit for it. Again, this is one that has an end of year deadline. If you're already itemizing on your tax return, then just make sure you get your checks to the charities so you get the benefit of those charitable contributions. However, a lot of you are not itemizing. A lot of you are taking the standard deduction, and the way that it works right now is that your standard deduction, you don't really get a ton of benefit for charitable giving unless you do certain things. So there's two key ones that we talk about with clients all the time if they're charitably inclined. One is the qualified charitable distribution. That is, if you're of the age of 70 and a half and above, you can pull from your IRA. Normally, when you pull from your IRA, it's 100% taxable. But if we do it properly through a QCD to a charity, that is a completely tax-free distribution. The pros of this is that you get to give the way that you want to give, and you get a tremendous tax benefit from it as well. We've done episodes on this if you want to go back and get more information on what a QCD is. But the big thing here is we're basically at a point where we're running out of time because the charity itself needs to cash the check by the end of the year. So this is one, if you say, man, I wish I did this, just take note for next year. But if you want to try to get it in this year, just work with wherever your IRA assets are and try to get it moving quickly. That's a big one. The other one, if you're not of the age of 70 and a half, you say, well, I want some charitable benefit. What can I be doing? We've done an episode on donor advised funds. It's basically a charitable account that you get to create for your family. It gives you the ability to go from being in the standard deduction to itemization, which now gets you a lot more benefit on your tax return, a lot more benefit for the charitable dollars that you do. And there's a whole strategy around this. Again, the account needs to be set up by 12/31. Now, the key here is that the account needs to be set up and funded. The charitable distributions do not have to go out for you to get your actual deduction. So this one, you could, if you move very quickly here, get this set up for the end of the year. So that's a big one on charitable giving. Also, with the donor advised fund itself, you can donate stock to it. You don't have to donate cash to it. So if you've got a highly appreciated Nvidia stock or Microsoft stock, you can put the stock directly into the donor advised fund. This is going to avoid the capital gains tax on the actual sale of the stock itself. And then now you get to get your deduction too. So it's a double tax benefit for you. Okay, as we approach the end of the year, making sure that we're kind of in line for taxes, taxes paid, taxes due is another big one. Taylor on our team, who we talk about on this podcast all the time, she has spent the last 6 months really working with clients and with our wealth advisors to make sure withholdings and estimated taxes are in line so that there are no surprises come April of next year and that we owe a lot more than we expected or we run into a penalty situation. So if you don't have active tax strategy working for you right now, if you don't know what you're going to owe or what you're going to get back next year, it may be worth a conversation to really understand what true tax planning looks like. We know all of our clients are in a position right now where they're not going to be surprised come April 15th of next year. And then the last one, this one's just kind of a, hey, take a glimpse at what your 2025 looks like, and any new documents. If you updated your estate plan, if you updated any medical documents, make sure you've got a good place where you've stored them. Make sure that people know how to access them. If you've updated websites or different types of subscriptions and all these different things that we sign up for and we kind of forget about, make note of where you're paying money, make note of your budgeting, your expenses. A big one that we just did an episode on is cybersecurity and passwords and all these different types of scams that are out there. So we need to be extra vigilant when it comes to monitoring our passwords, monitoring the websites that we are logging into. So it's always a good idea to keep a running list of that in some secure fashion or manner. So those are the big ones that we see that we want to make sure that you guys are talking about or thinking through as far as the checklist as we approach the end of the year. But we want to spend a couple more minutes on required minimum distributions because that is a big one.
Yeah, and before we get into that one, we did forget health savings accounts, HSAs. Really, really important. You get down the path and you forget that you could have put money in there. I just funded mine for 2025 as well. $8,550 if you're over, not over 50. If you are a family, $8,550. You do get a little bit of extra if you're over 55. But the key there is it's a really big tax benefit. I can put the money in tax advantage, meaning it's going to deduct off my income. It will grow now tax deferred, and then I can take it out tax free for medical benefits. Beauty is on this account, even if I don't want to use the money as I go, I can keep those receipts, and somewhere down the future, I could go take that money out. So I've been funding this now for years. I never take the money out for medical expenses. I'm just letting it sit and grow. But if in a few years I decide I want to go and use this money to go buy a car, as long as I've got my receipts that say that I spent at least that much money on medical expenses, I can go buy the car for tax free. And because I spent the money along the way on the medical expenses. So it is something that is a really, really big benefit. If you do not understand those rules, again, those are things to talk with us about. All right, let's talk about required minimum distributions. What is a required minimum distribution? Well, when we hit key ages, and now it's IRS, has really done it again to us. I'm just going to say it this way, depending upon what year you were born. If you already started, many of you have started your required minimum distributions when you turned 70 and a half. That means that you are now required to take a minimum distribution out of an IRA, your 401k, your 403b, anything that was tax deferred, you're required to start taking a minimum distribution. Now, just recently, the government updated this, and based on your years of a year of birth, for some of you, it's going to be 73. And then for some of you, it's going to be 75. Different episode to go through all the differences of that. Just know that if you're in that range, you might want to check and say, hey, do I have to take a required minimum distribution? All right, here's the big part of this. If you have hit those key ages for what year you were born, you need to take that required minimum distribution. And here is a big part of this. You do not have till April 15th. You have to do this by December 31st. So if you're listening to this and you've not done it yet, this is a big one because it comes with a hefty penalty if we do not take it. And a hefty one it is. I mean, it is a big time penalty. So we want to make sure that we are on it when it comes to this idea of taking this required minimum distribution. Now, there's some rules here as to how we could deal with whether we take it from IRAs, 401ks, 403bs, because I could do things a little bit different depending upon those accounts. So, Merce, if you kind of want to walk us through, let's just take IRA first and make sure everybody understands that, and then we can talk about the differences between a 401k, 403b.
Yeah. So what's nice is the calculation for the required minimum distribution. A lot of times the custodian is doing that for you. So custodian being like a Schwab or a Fidelity or an insurance company, they're running that math for you so you don't have to. Now you can reach out to them and ask what that required minimum distribution is. And you want to kind of get the total or get every single account that is required to take a distribution. You want to know what that number is for every single account. And let's just say you've got 5 IRAs out there, and they're all traditional IRAs subject to RMDs. What you can do, and sometimes it makes a ton of sense to do this, depending on your investment strategy, is you can take those 5 accounts and you can add up each of the required minimum distributions. Let's just say each one of those is $10,000. So 5 times 10, that's $50,000 of total distributions that need to be done. What the IRA allows you to do is that you can combine those and pull all 50,000 from just one account. That can make a lot of sense for people, just depending on how your investment strategy is. A common mistake that is made in this case is sometimes people think, hey, I can just take all of my RMDs, regardless of where they're supposed to come from an IRA or a 401k or a 403b, or even an inherited IRA. I can take it all from my one IRA, like that $50,000 example, and I'm going to be good. Well, that's not the case. The IRS wants us to differentiate between the different types of retirement-based accounts. So don't make the mistake of combining everything all together. In a simple rule of thumb, your IRAs, the required minimum distributions, those can be combined. Your 401ks, we want to make sure, check with your custodians, check with your advisor, but in most cases, those need to be taken separately. So if you have two 401ks, you need to withdraw those from the 401k, each individual 401k, 403bs. Just assume that those need to be taken separately unless you're told otherwise. Also, I mentioned the inherited IRA. That is always going to be separate based off of the inherited account that you have there. Those are really important. And those are under different rules. Those are under a handful of different rules depending on which year that you inherited it. So bottom line there. And the thing is, I've said the custodians will do the calculation for you on your IRAs and your 401ks and your 403bs. They will not do the calculation for you on anything that has an inherited idea to it, an inherited IRA, right? So those ones, you need to be working with someone to make sure you're doing the proper amount and the proper planning around them, because some of them you have to be done within 10 years. Some of them you have a lifetime to be able to take them out. So understanding those rules is often a misstep that we see, that we want to make sure it doesn't happen so we can avoid some of those penalties that Radon talked about. What else do we want to talk about on
I think
RMDs?
we've covered enough. I mean, right now we're sitting here at the end of the year. We've given you some homework to go do. I just want to remind you one more time, we do have a blog written on this. You can go to our website, pomwealth.net. You can go to the resources and you'll see the podcast. You can see the blog. And it just is a really nice way for you to be able to go back and review this. If we've brought up anything and you want to have a conversation, feel free to reach out to us. You can go to our website again, go to the Contact Us page, and feel free to reach out. We'd love to have a conversation. We hope you have a couple more weeks of a great year. And as we talk to you again in 2026, we think that we'll have some good information there as well. But we will talk to you again next week. We hope you have enjoyed this episode of Secure Your Retirement. If you would like to learn more, we have actually created an online course called 3 Keys to Secure Your Retirement. This video course helps you to think through all the different steps as you get ready to plan for and live throughout retirement. You can access this by going to our website, pomwealth.net. In addition, you can also subscribe below to our podcast called Secure Your Retirement.
For more retirement tips, check out these videos. Also, if you find them valuable, please subscribe to our YouTube channel and give us a like.